The S&P 500 is one of, if not the most popular index funds in the history of index funds. In July of 2023, the index is up 16.5% year to date, which is phenomenal. But the only problem with that is that it's being propped up by only a few very large companies. This means that of the 500 plus companies in the index, only about 10 or 20 are really pulling their weight, and the rest of them, 490 or so of these companies, are pulling everything down. Wouldn't it just be smarter to invest in those top 10 companies and cut the rest so that you can cut that dead weight? The S&P 500, like most major market barometers, is weighted by market capitalization. Essentially, the bigger a company is, the more room it takes up in the index. As a result, these indexes can get top-heavy. Currently, the top 10 stocks in the S&P 500 account for 30% of the entire index. The top 10 companies in the S&P 500 are Apple, Microsoft, Amazon, Nvidia, Google or Alphabet Class A, Tesla, Meta, Google Class C, Berkshire Hathaway, and United Health Group. And currently, year to date, most of these are on fire. Apple is up 53.88%, Microsoft is up 41.08%, Amazon is up 51.74%, Nvidia is going absolutely crazy and is up 196.28%, Google A is up 34.54%, Tesla is on fire at 158.85%, Meta is over 100 at 129.29%, Google C is up 34.54%, Berkshire Hathaway is up 10.64%, and United Health Group is actually down at negative 7.86. So I guess we can say the top 9 companies are actually the ones that are doing the work here. Awkward, United Health. The biggest companies in the S&P 500 by market value have become a lot bigger relative to the field. This means that the index is starting to become incredibly overweighted, and some people are starting to wonder why to even invest in the index more and not just invest in those top companies. So in this video, I'm going to give you some justifications as to why you might want to pick just the top companies and go that route, and I'm going to give you some justification as to why you might just want to pick the index fund and go that route. At the end of the video, I'll give you my pick and exactly why I pick what I pick, but in the comment section below, it'd be cool to hear your opinion. Which side do you fall on and why? So first, we're going to look at the justifications as to why it might be best to just invest in those top 10 or some very, very solid individual company stocks. And that first reason is just for the obvious, which is that these companies are absolutely crushing it, and for the foreseeable future, it looks like they're going to continue to crush it. These solid mega caps are so big and so dominant that it's crazy to even think that there's going to be a competitor that could even come and try to take any market share from these. Think about some new company trying to come in and take any market share from Apple. When you have a company worth more than most countries' entire GDP, you're going to be able to dominate for quite some time. Even companies like Tesla and Nvidia have crazy, insane competition, but still they're well positioned within that industry. They're just so far ahead in so many areas that it's hard to imagine them actually losing that top spot. The number 2 reason why it might be better to buy individual stocks over the index, over that S&P 500, is because most of the stocks, most of the companies in that index are just dragging the fund down. And not only that, if you were to pick companies to invest in, you probably would never pick most of the bottom 300 companies. And for that third reason, this is all about control. Say you really like a company and you think that it's going to do well, and it is actually doing well, and something like Apple. If you have a portfolio and you say you want 10% Apple or 15% Apple, you don't have that type of control if you're just investing in the S&P 500 or whatever index it is that you're investing in. If you buy more shares of the index, it doesn't make your percentage in any one of the companies go up. Everything rises equally if all you're buying is the index itself. So if you'd like to have a little more control in your portfolio, then it may make sense for you to be buying those individual stocks versus the index. And now let's look at some reasons as to why it might actually be better to go with the S&P 500 over those individual companies. The first one is that it's passive. You can set it and forget it. You can pretty much consistently rely on a return of 8 to 12% on average. Yes, there will be negative years, but also very positive years, like in 2019, where it had a return of nearly 30%. But on average and long term, it's a pretty consistent bet. Number 2, and this is going to be my biggest reason as to why somebody should go with the S&P 500 over individual stocks. And to understand this, you have to understand what it is that you're getting when you're buying into this index fund. It's not about the current makeup of the fund, and it's not even about the current year-to-date return. It's much bigger than that. When you go and buy an individual company stock, you are now in charge of that investment. You have to watch if that company's going up or if that company's going down. You have to watch how the economy's doing or how the world's doing. That might affect this one company. Because if this one company goes down and you have that one stock, that's really going to hurt your overall net worth. And if you do decide that you need to sell this stock because it's going down and you want to buy a different stock, not only do you have to figure out what that new stock is going to be, but you're also going to incur a tax liability because when you sell that stock, you're probably going to sell it at somewhat of a gain, hopefully. And so even if you plan on taking all that money and putting it back into an investment, you're still going to have to pay the taxes on that gain that you got from that first investment. With an index fund, they're doing all that work for you, and they're buying and selling certain company stocks, and so your portfolio is getting better, but you don't have the tax liability because you're not actually selling that actual index fund ETF. And specifically, the S&P 500 has it down to a science. This is why it's been one of the most consistent as far as average return for so long. When a company starts to underperform consistently, it gets booted out. When one grows and starts crushing it like crazy, the index adds more of it. That's why in recent years, Tesla and Nvidia have come into the top 10 and overwhelmingly so. Each year, about 20 to 25 stocks leave the S&P 500 and are replaced with other stocks that meet the guidelines for index membership. These changes usually are announced 5 trading days before the index change. The index was first introduced in 1957, and according to Inc.com, in 1965, companies lasted an average of 33 years in the index, dropping to 20 years by 1990, and forecast to drop to 14 years by 2026. Knowing this fact both proves my point that 1, the index is actively managing this for you, and 2, picking the correct stock long term is incredibly hard, which is why most fail. As you just saw, the trend is showing that most companies are not staying as dominant for as long. Companies are just coming up and taking this market share, so you never know which is going to be the one to hold for a very long period of time. The fact that ChatGPT and OpenAI took over the world just like crazy within a matter of days or weeks goes to show how fast new adoption of technology really works. The top 5 S&P 500 holdings in 1990 were IBM International Business Machines Corp., ExxonMobil, General Electric, Altria Group, and Royal Dutch Petroleum Co. Back at that time, people would think that it would be crazy for any one of these to not be in the top 5 30, 40, 50 years down the road. They just couldn't even think that that wouldn't be the case. But now in 2023, the top 5 are Apple, Microsoft, Alphabet, Amazon, and Nvidia. And while right now we can't really see a world where Apple or Microsoft or even Amazon aren't in that top 5 in some way or fashion in 30 years, that just might be the reality. The third reason and final justification for possibly going with an index fund versus those top stocks is because all we've looked at up until now as far as data is year to date, which is a terrible actual understanding of what the stock is, what the return is, and what you're actually getting when you're buying in. You need to look at a much more zoomed out picture to be able to figure out exactly what this stock has done and what the history shows. While Meta is up a crazy 129% this year to date, over the past 5 years, it's only appreciated 40% in total. The S&P 500 in 5 years is up over 61% in that same time period. So what am I doing with this data and with this understanding? My choice to invest any substantial amount of money would overwhelmingly be to pick an index fund over any individual stock. I'd pick a solid index fund like the S&P 500 or an ETF that tracks it like VOO or SPY as my foundational ETF, and then I would pick a solid dividend ETF like SCHD and a solid growth ETF like SCHG or QQQM just to make a solid portfolio of a bunch of solid indexes. I went over what I believe is a very accurate prediction of what the S&P 500 price will be by 2030, along with some very important info if you want to be a successful investor in the coming years. Watch this video now.